You can forget stock prices and job reports for a minute. If you really want to get a real-time pulse check on the U.S. economy, you got to look at the highways, specifically at the trucks rolling down them. And one of the biggest names you'll see out there is Old Dominion Freight Line. I mean, think about it for a sec. Nearly everything you buy, right? The food in your fridge, the phone in your hand, the parts for your car, it all traveled on a truck at some point. So when a massive company like Old Dominion, or ODFL as they're known, releases their earnings report, it's not just for investors. Nope, it's basically a checkup on the entire country's economic health. And that's exactly what we're going to dig into. Their latest numbers just dropped, and they give us this fascinating snapshot of where things really stand. So, what does this big economic report card actually say? Let's take a look. All right, first up, the Q3 scorecard. Before we get into the why or the grand strategy, we just need to look at the raw data. These are the headline numbers that tell the immediate story. Okay, the first number that just kind of jumps right off the page is this one. Total revenue was down 4.3% compared to the same time last year. Right away, that tells you something's slowing down. But the real question is, why? And here's your answer. It wasn't because they were cutting prices. It was all about volume. The total weight of all the stuff they moved each day, what the industry calls LTL, or less-than-truckload tons, well, that dropped by a pretty hefty 9%. Simply put, American businesses are just shipping less stuff. Let's just pause on this table for a second because the details here really matter. You see that top line, total revenue, is down, but the Y is right below it. Daily shipments are down almost 8%, and the total weight of those shipments is down 9%. That tells us two really important things. Businesses are sending out fewer packages, and the packages they are sending are lighter. Both are crystal clear signals of a wider economic cooldown. But here's the thing. This isn't just a story about one company's balance sheet. These numbers are really a symptom of something much, much bigger. So let's zoom out and look at the anatomy of this slowdown. And hey, you don't have to take my word for it. The company's own CEO, Marty Freeman, said it plain as day. He directly connected their results to, and I'm quoting here, continued softness in the domestic economy. When the person in charge of moving America's goods says the economy is soft, you should probably listen. Now, to really get what's going on with their business, you need to understand this one term, operating ratio. It sounds kind of technical, but it's actually super simple. For every dollar they make, what percentage of it do they have to spend just to run the business? The best way to think about it is like a golf score. The lower the number, the better you're doing. And ODFL's ratio went up, which is not the direction you want it to go. It means their profitability took a hit. And this, right here, is such a critical piece of the puzzle. This wasn't just some minor dip. You see, historically, ODFL's revenue actually grows by almost 3% between the second and third quarters of the year. It's a seasonal thing. This year, it actually fell a little bit. That break from the normal trend, well, that's what people in the industry call a freight recession. So if you're in a tough market like this, what's your move? What do? Let's dive into their playbook and see exactly how Old Dominion is trying to navigate this storm. The first thing to know is that ODFL isn't panicking at all. They're just sticking to the game plan they've had for years. And the absolute cornerstone of that plan is delivering premium service. They refuse to get dragged into a race to the bottom on price. Instead, they just keep investing in their facilities, in their tech, in their people, all while holding the line on pricing. And look, this isn't just some corporate slogan they put on a poster. Here's the proof. 99% on-time service, and a cargo claims ratio, meaning stuff that gets lost or damaged, of just 0.1%. In the world of logistics, those numbers are just unbelievable. In an age where supply chains are chaotic, they're basically selling one thing: rock-solid reliability. And it's not just them patting themselves on the back. An independent industry survey just named them the #1 carrier in the country for the 16th year in a row. That doesn't happen by accident. It happens because of that relentless focus on service, and it's why their customers are willing to pay for that quality. So this brings us to what is honestly the most fascinating part of their entire strategy. They are playing the long game by investing right when everyone else is cutting back. I mean, just look at this contrast. When a slowdown hits, what's the typical reaction? Slash costs, shrink your network, do whatever you can to protect profits for the next quarter. Old Dominion, they're doing the exact opposite. They just keep investing, building extra capacity so they're ready for the rebound, and they're focused on winning market share for the long haul. So just how much extra capacity are we talking about? Right now, it's over 35%. That's way above their normal target. It's kind of like a highway department building 5 extra lanes during a traffic lull. Yeah, it costs a ton of money right now and the road looks empty, but they're betting that when rush hour returns, those lanes are going to be full and incredibly valuable. Now look, this strategy isn't free. It absolutely hurts their profits in the short term because they're paying to maintain all that unused capacity. But the big wager they're making is that when the economy finally turns around and everyone else is scrambling for space on the highway, Old Dominion will be the one carrier that can confidently say, "Yep, we got room for you." Okay, so this all leads to the big multi-billion-dollar question. What happens next? How is all of this positioning them for the rebound that everybody's waiting for? I absolutely love this. You gotta appreciate the honesty from the company's CFO, Adam Satterfield. When he was asked when the market will turn, he joked that he asked ChatGPT and it said next year. It's such a great, lighthearted way of saying what everyone is thinking. Nobody really knows, but you have to be ready. And this is the absolute core of their bet. They believe that when demand does come roaring back, the entire trucking industry is going to have less capacity than before. So, by investing now when others aren't, they're putting themselves in a position to be one of the only players who can handle that surge. And they think they can grab a huge slice of the market because of it. So, here's the thought I want to leave you with. Old Dominion is making a massive, multi-billion-dollar bet that in the crazy, turbulent world of logistics, quality and consistency will always win in the end. They're spending through the downturn so they can be ready for the upturn. And as the entire U.S. economy is sort of sitting at a red light, waiting for it to turn green, the big question is, will their bold, long-game strategy actually pay off?